Tax-free annuity exchanges might sound like one of those confusing financial terms only advisors understand. But trust me, once you get it, it's a powerful tool for your long-term money game. Stick with me because by the end of this video, you'll not only know what a tax-free annuity exchange is, but you'll also learn how smart people use it to build retirement income without a surprise tax bill. And there's one key detail most people miss that could save you thousands. You'll want to hear that before you make any decisions. Let's break it all down, nice and easy. Number 1. What is an annuity? Anyway, before we get into exchanges, we need to understand what an annuity is. An annuity is a financial product sold by insurance companies. You pay money into it, either all at once or over time, and in return, it pays you income in the future, often during retirement. Think of it like a personal pension plan. There are different types. Fixed annuities give you a guaranteed return, variable annuities let you invest in the market, and indexed annuities are tied to a market index like the S&P 500. Example, imagine you pay $100,000 into a fixed annuity today. In return, starting at age 65, you might get $600 a month for the rest of your life. Not bad, right? Number 2. What's the problem with some annuities? Many people buy annuities and then later realize that their original choice wasn't the best fit. Maybe the fees are too high, the investment options are outdated, or the benefits just don't match their retirement goals anymore. But if your money is already in the annuity, what can you do? If you cash it out early, you might face surrender charges and a hefty tax bill, especially if it's grown in value. Example, let's say your annuity has grown from $100,000 to $130,000. If you withdraw it, that $30,000 of gain could be taxed as ordinary income. That's a painful surprise during retirement. Number 3, what is a tax-free annuity exchange? 1035 exchange. Here's where things get interesting. A Section 1035 exchange, named after a part of the IRS tax code, lets you move money from one annuity to another without triggering taxes on the gains. It's like a swap under the IRS's radar. It only works if you go from one annuity directly into another. You can't take the money out and then redeposit it yourself. That breaks the chain, and the tax benefit disappears. Example, let's say you have a variable annuity with high fees and you want to switch to a low-cost fixed annuity. With a 1035 exchange, you move the entire value, say $130,000 tax-free into the new one. Your $30,000 gain stays untaxed until you start receiving payments from the new annuity. Number 4, what can you exchange? The IRS allows you to use a 1035 exchange not just between annuities, but also from life insurance policies to annuities. However, you cannot go the other way. No exchanges from annuities into life insurance. Example, if you have a permanent life insurance policy with cash value that you no longer need, you could use a 1035 exchange to move those funds into an annuity that pays you income later in life. This can turn unused insurance into retirement income. Number 5, why do people use 1035 exchanges? People use them for lots of reasons: lower fees, better investment choices, newer annuity features, or more flexible payout options. It's basically a way to upgrade your annuity strategy without paying taxes up front. Example, suppose your old annuity charges 2.5% annually in fees, but a new product offers similar benefits at only 1%. Over time, that fee difference could save you tens of thousands of dollars. A 1035 exchange lets you make that switch without losing money to taxes immediately. Number 6, what are the rules and requirements? There are a few important rules you must follow to qualify for a tax-free exchange. The exchange must go directly from one insurance company to another. The owner and the annuitant, the person receiving the income, must remain the same. The new annuity must be set up before the transfer occurs. Example, If you withdraw the money and then try to fund a new annuity with it, even just a day later, you lose the 1035 benefits and pay tax on any gains. That's why it's crucial to have both companies coordinate the exchange directly. Number 7. Are there any downsides? Yes, there can be. Some companies charge surrender fees if you leave an annuity too early, especially within the first 5 to 10 years. And the new annuity might have its own lock-in period. Also, if your original annuity offers certain guaranteed benefits, like a death benefit or income rider, you might lose those when you switch. So you need to carefully compare before making a move. Example, say your current annuity has a guaranteed lifetime income of $800 a month, but the new one only offers $650. Even with lower fees, that could be a loss in the long run. You need to weigh all features, not just the fees or tax savings. Number 8. How do you actually do a 1035 exchange? First, talk to a licensed financial advisor or insurance agent. They'll help you evaluate your current annuity and see if a new one fits better. Then, if it makes sense, the new annuity provider will handle the paperwork for the 1035 exchange. This involves coordinating with your old annuity company and ensuring the transfer is done directly. Example, you sign an application for a new annuity, check the box for 1035 exchange, and the new insurer requests the funds from your old account. You never touch the money yourself, and that's what keeps it tax-free. Number 9. What happens later? When you withdraw money. Even though the 1035 exchange delays taxes, you will eventually pay taxes on the earnings when you take money out of the new annuity. It's not tax-free forever, it's tax-deferred. Withdrawals are taxed as ordinary income, not at capital gains rates. This means if you're in a lower tax bracket in retirement, you could still benefit significantly. Example, suppose your new annuity grows to $200,000 and you start taking out $1,000 a month. A portion of that might be your original money, which isn't taxed. And a portion is earnings, which is taxed. The insurance company will give you a breakdown each year. Number 10. When should you consider a 1035 exchange? A 1035 exchange makes sense if your current annuity has high fees or poor performance. You want different investment options or payout flexibility. You're holding a life insurance policy you no longer need. You're planning ahead for retirement and want more predictable income. Example, if you're 5 years away from retirement and want to lock in a guaranteed income, moving your existing annuity into a more modern version through a 1035 exchange could help you feel more secure and possibly save money in the long run. Number 11. What's the one mistake people always make? Here's the big one. People rush into exchanges without doing the math. A flashy new annuity with bonuses or lower fees might look attractive, but if it means giving up valuable old benefits, it can backfire. Always compare both products side by side, ask for a detailed breakdown, and don't make a move unless you fully understand what you're gaining and losing. Example, a newer product might offer a 10% bonus on your deposit, but in exchange, you're locked in for 15 years with higher surrender charges. Is that worth it? Only if the long-term benefits truly outweigh the trade-offs. Now that you know what tax-free annuity exchanges are and how they work, here's my question for you. Would you ever consider using a 1035 exchange to improve your retirement income plan? Or does the complexity still seem overwhelming? Drop your thoughts in the comments. I'd love to see what you think.